Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. We're here again with our friend Clayton. Welcome back.
Thanks, man. Cheers.
Cheers. Another day, another beer.
Yep.
Okay. So we're going to talk about one of my favorite topics today. I did a video years ago about this maybe 10-minute video on Facebook, but we're going to talk about real estate versus stocks and the returns that we see with those, and why you might do one versus the other. If you're hearing, if you're listening to YouTube videos or you're talking to somebody that says one is significantly better than the other, we might overcome some of those conversations today. So
that's the hope here.
Yeah.
So, because usually when you're in the situation, it's a person who's on one side or the other one, right? Like I think about the Robert Kiyosaki book, right? Rich Dad, Poor Dad. What does it talk about? Real estate and real estate only.
Yep.
And that's his side of it, which is great. And then you have the other ones who are investment only professionals. We should only do investments.
Right. And there's like
very one-sided,
ultra high net worth individuals on both sides of it, right? Yep. So like Robert Kiyosaki can make an argument all day long. I think Kiyosaki's worth $200 million.
Yeah,
and
he's
it's
doing all right.
And it's he's doing great. And it's all. I want to check something here. I just thought about this. We're good. Okay,
nice.
We're good. Yeah, he's worth $200 million in basically all leveraged full real estate. And one of his things that he'll tell you is benefited and doesn't pay any taxes.
Yep.
That's one of the advantages that we'll talk about on the real estate side. Yep. But ultimately what we see is you're 100% right. You're on one side of the fence or the other. Mm-hmm. And perhaps it's because you have an ulterior motive, right? Like we talked about maybe as a financial advisor that gets paid on the amount of funds that they're, overseeing. They may say, "Oh, don't go into real estate," or you're working with a real estate broker that is like looking at their next commission check, going, "Hey,
this is my revenue over here."
Yeah, you don't need to invest in stocks. Just buy real estate.
Buy another house.
And then the client says, "Well, what if I just buy REITs?" And you're like, "Don't worry about REITs. Like
they don't count.
those aren't the same. Those aren't the same as real estate." So anyway, we're going to talk about stocks versus real estate today. So. I want to start just with a statistic, kind of with some historical data. That's usually a great way to get the conversation started. And so historically speaking, if we look at the numbers on a very basic level, it seems as though we have an answer to the real estate versus stocks argument.
Yeah.
Right? And so the statistic that we're talking about comes from the Federal Housing Finance Agency, and it's that the compound annual growth, which if you've listened to all my podcasts, that compound annual growth rate is the proper way to account for your gains and your losses, not average annualized return. Compound annual growth rate is the proper way to do this.
I'm glad that you do that. Actually, I didn't even realize that until just now, because a lot of people talk about average annual return or average return.
Yeah.
And they don't actually do it properly. Yeah. Because like the calculation doesn't equal the same thing if you're doing a average return versus actual compound.
That's right.
Interest.
And it will, unless you have any singular year with a negative.
Correct.
And so that's where, I always tell people, like, think about it. If you had $100,000, right? And in your first year, you lose 50%.
Yep.
Okay. And in your second year, you gain 50%. Your average annual return is 0.
Yep.
But you lost $25,000.
Lost money. That's the exact same scenario I use with every single one of my clients. If I give you $100, then I take it away and then I give some of it back. You still lost 25. Right?
Yeah, you still lost $25. You lost 25,000. So compound annual growth is the proper way to calculate this. So anyway, the compound annual growth rate of real estate over the last 47 years, which is a great data piece, right? If I just said it was over the last 3 years, I would probably give you a number like astronomical, and it's not a great view of the whole thing, but 47 years is a lot of data. And so anyway, real estate on a national level as a compound annual growth rate over the last 47 years was 4.85%. Okay. The S&P 500, okay, which is a pretty standard metric for what we look for stock market returns, right? Like we look at things based on the S&P 500. But if you reinvest your dividends, okay, which you probably should, okay, you reinvest your dividends, you're looking at a 11.85% return. Okay, so that's a 7% difference, which doesn't seem like much until you run it over 47 years. And so to put it into perspective, $100,000 invested in real estate 47 years ago in 1975 would grow today if you didn't do anything else. If you bought a property in cash for $100,000 at the average or the compound annual growth rate of 4.85% would be worth $928,000. Okay. $100,000 in the S&P 500 from 1975 would be worth $19,351,000. Okay,
so this is where we stop the conversation.
Right, that's where it ends.
It's over.
Real estate or stocks? We answered the question. Everybody, thanks for joining in. Live big. So ultimately, what happens is this is where the argument comes from people that are on the stock side, right, of the fence, where they're like, "Oh, stocks are way better. Look at this statistic." And if I suppose for like the layman individual looking at these numbers, you'd be like, yeah, I guess
why not?
I guess you're right.
Yeah.
So first of all, those numbers are pretty cool to look at. I mean, think about even if you didn't have $100K to invest, if you had $10,000 to invest in 1975, you'd be a multimillionaire. If you never did anything again.
Still works. Yeah. Here's something funny. You mentioned, 47 years in my mind, I literally went back to like 1940s for some reason.
Yeah, it's 75.
1975. 47 years is, in the grand scheme of things, it's really not that long. We just pulled 1975 where we set at today. So I think that's going to be a piece that's going to really put some stuff into perspective too, because 1975 wasn't substantially long ago, but we've had a lot happen since then. So these numbers make a lot of sense too in the average annual or the compound interest returns that we're talking about. That's crazy.
Yeah, the numbers are kind of astounding when you think about it, because like you said, I mean, if you're 20 years old and you're fairly shrewd financially, right? Because maybe somebody taught you went and hired a financial planner to teach you what to do, and you were like, man, I got 10 grand. I graduated college, I graduated high school. What should I do with this $10,000? And they go, hey, in 47 years, you'll be 67 years old, which is the average retirement age right now. I think it's actually higher than that right now.
Yeah,
but at 67, it's a decent retirement age. If you just take that 10 grand right now and invest it in the S&P 500, you'll have $2 million if you never do another thing ever again. And that means you go and have a job that offers a 401k. Nope, you don't contribute to it. You don't do anything.
You still have almost $2 million.
You have $2 million. Absolutely. That's a cool thing to think about, right? So what happens is we get this misconception because we don't understand where the power of real estate lies. And so 100%, if you had $100,000 in cash and you bought a property for $100,000 or stocks for $100,000, you're going to get beat every single time by the stock market. What we fail to remember is that the power of real estate lies in one of the things that we've talked about in at least half our podcast, which is the power of leverage. Okay. You're a financial planner. You do a stock slot. Can I buy $100,000 worth of Apple stock for 20 grand?
Cannot.
Okay. So can I buy $100,000 worth of Apple stock for 5 grand?
Yeah.
I can?
Well, $100,000 of Apple stock. Oh, with 5 grand. No.
Sorry, 5 grand.
I think it went the other way around.
No. So
no, you can't.
In order to buy $100,000 worth of Apple stock, I have to have $100,000. Okay.
I mean, you can leverage it to some extent, but we're completely removing that with margin, right? Because okay, we can, but it's not 20%.
No.
Not even close to that. You need a lot more than. But the other side of it is, this is, I guess, a point to you though on that. We don't receive income on that,
right?
As an investor, you now own the stock with less dollars, but you have to pay that back at some point in time, and somebody else is not doing that for you.
That's right.
I just gave him one, so dang it, he's got one up now.
Here we go. Just start chalking them up. Get your whiteboard out and start a tally sheet here. So so the piece that we have to understand is that the power of real estate lies in leverage. Okay. Yep. So what we can't think about is buying $100,000 worth of real estate with $100,000. We need to think about buying $500,000 worth of real estate with $100,000. Mm-hmm. And I'm going to keep this very because these numbers could get really crazy if we start implementing some of the things that we've talked about in prior episodes, like house hacking, right? Mm-hmm. So everything I'm going to talk about right now is based on a 20% down payment, knowing that that's kind of the minimum. You could do it for 15%, but you shouldn't.
Push, yeah,
you shouldn't. Right. So at 20% down, you're an investor, and the numbers I'm about to talk about are 20% down on everything. But keep in mind, there's ways to grow this even more exponentially using methods like house hacking methods, using methods like BRRRR methods. There's ways to increase these gains exponentially. But so if the idea was, if you were back in 1975 and you had $100,000 and you were buying real estate, you shouldn't buy $100,000 worth of real estate in cash. Mm-hmm. You should actually buy $500,000 worth of real estate leveraged at 80%. So let's talk about that number. If you took that property and you gave it 4.85% compound annual growth for 47 years, that first property that you bought for $500,000 would now be worth right around $4.6 million. It still doesn't even hold a candle to the 19.9. Okay. Now, if you just had that property, okay, and you bought it, and let's say you never even refinanced it, right? And obviously we want to take opportunities to lower our rate anytime where the rate climate allows us to. But if you never refinanced it and you never had cash flow,
right?
Okay, which would be unheard of. Right, it would be impossible. Yeah. But if you never had cash flow in 47 years, you would have turned $100,000 into 4.6 million. Okay. That is not 4.8%. That's actually closer to like 20%. Mm-hmm. Okay. And so right then and there in property number one, using leverage. And at this point, after 47 years, it's paid off because we're in a 30-year mortgage. Yep. Right. And let's say it wasn't cash flow positive because you had a mortgage on it. After 30 years, now it is cash flow positive. So for the last 17 years, you have cash flow on this property. Yep. So not only is it worth 4.6 million, which is a 20% annualized return, but now you also have cash flow on top of that. The number that we use for the stock market with 11%, 11.85% is dividends reinvested. Right. So there's no cash flow on that real estate or on that stock investment. Now, the idea behind this is, as we play devil's advocate, and I'll put a check mark back in the stock market side of things, is that there's significantly more work and involvement in owning property. Right. So the cool thing about looking at that number of 19.3 million is that
you did nothing. Literally nothing.
You did nothing. You put $100,000 in, you gave $100,000 to your financial advisor
and walked away.
He dropped it into a Vanguard Mutual and done.
Sends you a 1099 once a year.
That's right. So that's pretty cool. The 47 years of property management, on the other hand, causes a little bit of stress. Okay. You get tenants calling you and letting you know that the furnace broke and that the windows need to be replaced and you need to replace the roof. And maybe there was a hailstorm and it smashed up the siding and whatever. There's some stress involved there. There's some work involved there, right? So, and we're still only worth 4.6 million.
Right.
So we're not even close to the 19.35. So again, at this point, even if we leverage, we still go, okay, the stock market's still better. So why am I buying real estate? The point is that piece of real estate appreciates over time, and it gives us the opportunity to re-leverage and grab money to make more investments. And heck, if I'm really being honest, we could take that $47,000 or that the $100,000 that we re-leverage, and we could buy $100,000 worth of stock in year 42 if we want,
and then do that.
And it's probably worth 16 million instead of 19 million, right? But the point is that if property is appreciating at 4.85% per year, that means right around every 4 years, a $500,000 property would be worth just over 600,000. Every 5 years, it's worth about 633,000.
Mm-hmm.
If you were to then every 5 years take $100,000, re-leverage $100,000 from that investment, and buy another property. Now, all of a sudden, we buy a property at 47 years, 42 years, 37 years, 32 years, so on and so forth. And by the time we get to present day, we own 10 properties.
Yep. Okay.
The value of those 10 properties now is $19.9 million.
Okay.
So now we're getting there. Now,
pretty close.
We're even.
Yeah.
But we also have to keep in mind that our properties, because we kept re-leveraging them, okay, we owe, I did the math on it, but we owe right around $1.5 million in mortgages at this point. Okay. So we're not quite there, but we're darn close.
Yep.
But now you own 10 properties.
10 properties.
And you've got 10 roofs to replace and 10 furnaces to worry about and things like that. So again, playing devil's advocate, where do we want to be? If I know that if I'm not wanting to worry about it, if I have the choice to have $19 million in real estate or $19 million in stocks, I'll take the stock.
Right.
I'll take the stock.
From the easy button.
Yeah.
Yeah, sure.
Yeah. So because we're having to worry about 10 leases that are up every year and 10 properties to worry about. So the big thing here is we haven't even begun to talk about the amount of cash flow that those 10 properties would start to produce you over a 47-year period. And we haven't taken into consideration, in this particular instance, I only re-leveraged each property one time.
Sure.
Right. So on a property, that very first property we bought that's now worth $4.6 million, owned free and clear, we only re-leveraged it once for a total of $100,000. Technically, you could re-leverage that property every 5 years for an extra $100,000. And so over the period of almost 50 years, you would have re-leveraged it 10 times and pulled $1 million out of it. So even if you pulled $1 million out of it, you still have $3.6 million in equity. But it would allow you, if you re-leveraged each of those properties every 5 years, it would allow you to purchase not just 10 properties, but somewhere in the neighborhood of 45 to 50 properties.
Yep.
Okay, those 45 to 50 properties, the first one being worth $4.6 million and the last one being worth $500,000, because we're using a very fine, every property you buy is worth $500,000.
Right. Yep.
Okay. So our average of our 45 properties is between 5 and 4.5. So basically $2.2 million, $2.5 million.
Sure.
So now you've got 45 properties worth $2.5 million a piece. And now we're pushing the $100 million asset range. And you probably got, each of them, let's say they each have $400,000 at 40 properties. You have $16 million worth of debt. Okay. So now you're somewhere in the range of 80 million, which is 4 times the stock market return. Yep. Okay. So this is where my argument from the real estate side comes in and says, you have the ability to create a tremendous amount of wealth on the real estate side that I don't believe you can create on the stock side. What do you think?
From the leverage standpoint.
From a leverage standpoint.
Correct. Yeah. I mean, the leverage is what makes you happen. So I'm not going to disagree with that, because it is 100% right. And you have to have that philosophy to do it, and you have to have the time frame to do it too, right?
Yep.
And again, we're also talking with the stock market. We did $100,000 one time when we were 20 years old. Let's use that as the example.
Yep.
And we never invested one more dollar.
But I didn't in my real estate either.
That's true. You did
not of my own money.
Yeah, that's right.
It's all re-leveraged.
We didn't do any of the new investments or any cash
and we didn't
flow
use any of the cash flow.
That's right. We didn't use any cash flow out of it. So from that side, you can definitely do that a lot more there. So what happens when we come on those years and they come around from time to time where it's just really, really tough? Interest rates are through the roof. Rental is tough. Whatever it is, we all markets. We have it too. Real estate. We all have those same times that it becomes really, really tough, and we have to make very, very hard decisions.
Yep.
If you're sitting in a place where you're on the first couple years of it, and that's the decision you have to make, how can you how do you do that? Again, this is not wrong, but you have to be willing to have that conversation. How are you going to make that decision? Right?
100%. So you could easily be derailed on this process, on this real estate process. And I'll tell you, I feel it right now. I've got a bunch of properties at 3% leverage.
Yep.
right?
That's awesome.
Like they're all 3% interest rates, not 3% leverage, 3% interest rates. Okay. It's really hard for me to stomach buying a property right now at 7 or 8%.
7 and 8. Yep.
Okay. So what happens is this timeline that we set up of buying a property every 5 years is, it's, first of all, it is very feasible. This is very feasible to do.
No question.
However, the emotions take place. Interest rates get high, prices get high, and you go, well, let's wait a year.
Yep.
And then prices get higher and interest rates get higher. So you wait another year.
Yep.
And now you're off track. And the thing is so if you can sit here and create this plan and create a veil of ignorance that says, I don't care what prices are, I don't care what interest rates are.
Yep.
I'm buying a property every 5 years.
Yep.
I think it's safe to say you can come out on top with numbers like this.
Sure. Yeah.
The problem is we don't have a veil of ignorance.
Nope.
It doesn't exist.
Nope.
And so we let external factors like interest rates and like the current market and maybe political issues and war in the world and debt ceilings and all the things that we talk about, we let those affect our decision-making process because we have fear.
Yep.
Right.
That's scary.
And so how easily does our stock market investment of 100,000 going to 19 million get derailed? It doesn't. We just don't even look at it. We like it.
Right. But it still can, but less risk, right? The opportunity of failure with an investment in the market is less. Right? The opportunity of failure with making a bad decision or letting emotion get involved, buying a bad property, having a bad tenant. I mean, the risk just gets a little bit higher, right?
Agreed.
So I think where you're coming from, if you're just looking at it from a straight standpoint of like one versus the other one, the risk you're taking for the real estate, you should be compensated for it. And it's not the 4.85%, it's the leverage.
That's right.
That's why you do that.
That's right.
But there also is the risk associated with it by making a bad decision that it was a bad property that cost me money.
That's right.
I have bad tenants in it. I also would say that the first probably 10 years are probably the hardest, I would guess.
Yeah.
And in 10 years, but that's not when we're doing this, we only bought a property every 5 years.
So it's three properties. It's three properties.
So that's still not quite enough, I think.
But if we're talking about the $80 million one that I was talking about.
Yep.
Now we're 6 properties.
6 properties. Okay. So that's now if we're doing that number, that's the number that I think is more realistic, right? Because if you're going to do it, that's what you have to do.
Yep.
But the opportunity for failure is greater in those first probably 10 to 15 years, if I would guess. Because what happens in those first timeframes, you have the most leverage in theory with the least amount of equity. Right? Yep. Your debt to equity ratio is the highest in those beginning years because you don't have the appreciation yet because you have a smaller return on the compound.
Yep.
Right? So much higher leverage ratio.
Yep.
If you make a bad mistake or shit just hits the fan, sometimes it's out of our control. Or guess what? You decided to get married and have a kid and something changed.
Yep.
That's where the risk is involved, in my opinion, right? And that's the hardest time. Now you have 2 choices here. You move forward and keep really nose to the grindstone and make it happen, or you change track.
Right.
How do you change track? I think is the biggest decision in that situation for real estate. It's still going to work. It may not be as efficient as just the S&P. If we're just looking at black and white numbers, we haven't run these numbers yet. This is a conversation we're having here now. So I don't know how it turns out. I feel like if we have 6 properties in the first 10 years or we have 9, 11-ish in 15 years, those properties are still going to do approximately that same amount we talked about if we did the one, right? Mm-hmm. Maybe a little bit more. Yeah. So we're now equal.
Yep.
We just stopped. So now we're still pretty equal in there. So it's understanding the risk you're jumping into and how you have to pivot and make decisions.
Yeah.
And you said that earlier with the stock market. That's the easy button.
It 100%.
It is the easy button.
And so the thing to think about, I think for the average person, right? Like if you talk to the average person and be like, hey, you want to be worth 20 million or 80 million?
Yeah, I'll take 80 million all day long.
But I think they'd also be like, I'll also take 20.
Yep. I mean,
right?
It's true.
So think about it this way. If I was like, hey, you can be worth 20 million bucks and not have to do anything. Or you can be worth 80 million, but you're going to run a business.
Yep. Okay.
That's the thing that we have to think about. Like, so owning real estate, by the way, especially not just owning like one rental property, but owning 40 properties in this case, that is a business.
That is a business.
At 40 properties.
You're not doing that by yourself either.
No. At 40 properties, you are having at least one or two full-time salaries worth of expenses, whether you outsource it to a property manager or you have your own person internally that runs those properties for you. You have significantly more expense than you have your money in the stock market.
Absolutely.
Okay. So you have more expense and you are running a business. Okay. You have a couple of employees.
Yep.
That employee, your longtime employee leaves that used to do all your lease. And you're like, oh my God, I have 4 lease agreements coming up. Because think about it, if you have 40, it's called 48 properties to make the math easy. You have 4 new lease agreements every month.
Yep.
1 a week, basically.
Yep.
Every single week.
You're redoing a lease.
You're redoing a lease and trying to find a new tenant.
Yep.
Potentially. It is a full-time business plus some.
Yep.
So the idea is some people look at this and they go, I don't need to be worth 80 million. And I would be like, I could see that. Why you don't need to be worth 80 million. So you really have to think, and this is why we get back to one of the things that we talked about in our previous episode was like, what are your goals?
Yep.
Do you truly want to be worth $80 million?
Yep.
Because if you do, I think I can help you make that happen.
Yep.
Right? I really do. I really believe I can make somebody worth $80 million, okay, in using real estate and being consistent and not straying the path, right? And what I've found so far with people that I've worked with, that is so difficult.
To get them to get on that.
Just to not stray the path.
Yeah, get on that path.
Because the other part about the first 10 to 15 years that we talked about, that it's slow.
Very slow. You don't see anything.
There's nothing for 10 to 15 years. Okay. But also I would argue that there's nothing $100,000 worth of stock in the first 10 to 15 years.
No, that's the hardest time for investing too, because that's when you feel the returns negatively the most. Because you're going to have a massive negative year in 10 years and 15 years. And that's the hardest one, because when I say negative, I mean, the S&P in 2008 was down 53% from top to bottom. Right. 53% of your value was declined in 1 year. Yeah. That hurts.
Right. And we can, with that statistic right there, we can accelerate one of our pros and cons, which is, overall, real estate is less volatile, significantly less volatile.
Yeah, what's funny is I talk to my clients about this all the time, is that, you know what, your real estate, like they're giving me a hard time about the volatility of the market. So, and then I push back and say, I bet you your house is just as volatile.
Right now.
You just don't get a statement every month.
Right.
You don't have an account you can pull up and take a look at the value today. That's a true value that you can liquidate immediately. Right? Like, you don't have that immediate access to information. Now, Zillow and Redfin and all these technologies are starting to show up to give us a little bit more of that. It's kind of funny. I've actually used that on my clients. Oh, we're more volatile in your house. My house is stable. And it's an education experience. What I do for them, I pull up Zillow, I put in their address, and I show them. They show you the graph. I was like, look, it's down too.
The volatility of the real estate market, just so you know, January 1st of 2022 to May of 2022, 16% here in Colorado. So up 16% in 5 months, which is annualized. Annualized is 40%.
Yep. So, 5 months. Yep.
Yeah. So it's annualized. That is a 40% annualized return, which first of all is unheard of in real estate.
That's not real.
Okay. And then that 16% was pretty much lost completely by the end of the year. So then down 16% in 7 months. So again, annualized, that's like 28%. Okay. And then January 1st of 2023 or basically December of 2022 until basically now, up 10%.
Up 10. Okay.
So that is extreme volatility. So you have a great point there when it comes to talking to people about like stock market volatility.
Yeah, it's all the same. And so like if we bring the picture, to me, it's an investment. At the end of the day, we're investing in something. And what does that look like? What's our return? And to make it work, you have to compound it. Like, it has to happen. So when I'm talking to my clients about real estate, I'm like, you can't buy one. One doesn't work. I'm sorry. I mean,
it doesn't work well.
Right, it doesn't work. I mean, I guess it
works.
It's there,
doesn't work
right?
well.
But you showed me the numbers. What, 47 at 4.85 equals what?
4.6 million.
4.6 million. It doesn't work. Like that. That's not really
one.
Like we're 1.85% above inflation. So if I take that same $100,000, it's actually, $3 million.
Yeah.
So it really, we've only made 1.8 million in that point of time.
Exactly.
Right.
Yeah.
So
it's a great argument.
So when we're looking at it from that point, like 1 doesn't work, 2 doesn't work, 3 doesn't work. Like we don't start getting it to work until we get above 10.
Yeah.
And if you don't have the stomach, so back to your point, what is your goal?
That's right.
And what do you want to accomplish? If I want to have real estate because that's what people do once they have some discretionary income, wrong answer, probably don't do it.
Yep.
If you want to create a higher net worth over a long period of time, that's going to be a lot of work and you're willing to do it, that's a damn good answer.
Yep.
Right? But it is a business plan. It's not a let's hope and pray. And so I've kind of come up, and this is just kind of a random number I came up with without even doing any of these math. I've never done the math on it like this. But I always tell my clients that if you don't want 5, you're not doing this. And I wouldn't do it unless you want 10. Like that's really where it starts.
I appreciate
to
that.
work.
Send those people my way, by the way.
Yeah, sure.
Ones that want 5 to 10.
Yep, absolutely. but that's when it makes sense to me.
It makes you're exactly right.
Because if we didn't include any of this in there either, is the whole conversation about the cost of doing business, right?
Yep.
We didn't include taxes, and we included dividends reinvest in the S&P 500. You didn't include income, so we have a couple things that are on the outside. We were trying to make this from the foundation as easy as we possibly can to compare apples to oranges, right?
Yep.
One's red and one's orange. Okay, great, got it. That's the difference. Sort of. But there's a lot of other things underneath. But at the end of the day, they're both fruit.
Right.
Got it. Love it. Both of them are investments.
Right.
I love that. But where I was going with this is like property management fees right now are what? 10% on the 10%? Yeah, 10%. So we're getting a 4.85% return and we're paying 10%.
Yeah. So we're really getting 4.4%, and then inflation's already 3%. So it's a 1.4%. And you can look at it that way.
Yes.
So that's a great way to look at this, because one of the things that I would say is if you were to take just my knowledge of real estate finance and pit me up against somebody who has great knowledge of, stock market finance, I will tell you, I feel supremely confident that I will destroy that person in an argument of building the most amount of net worth you can possibly build. Okay.
Opportunity to do that.
So, yeah. So for example, if somebody got with me and was like, and sat with, let's say a stock market advisor and a real estate advisor, and I'm the real estate advisor, and then we say, what is your goal? And that person says, I want to be worth so much. I want to make so much money. I want to have so much money. Like, I want to build this tremendous amount of wealth to pass on to my kids or whatever. I'm like, you need to come with me. Like, don't even talk to this stock guy. Yeah. Like, I'm going to crush him.
Yep.
Okay. But you're 100% right. If you have $100,000 to invest and you're only going to do it once,
it's not going to work.
Do not do it in real estate.
Do not do it. No.
Right. Like if you go, maybe I'll just do one property. No, just go buy stock.
Yep.
Okay. Like that is true. And I actually haven't really thought about that before, because my mentality is always, why would you buy one?
Right.
Like real estate's like Lay's potato chips. Like,
right.
Can't just have one. You can't just have one. You can't just have one. Right. So like the idea is, here's the only time where I would say, hey, it's okay to just have one, or it's okay to just have two. And that would be if you were using the house hacking method, which I would encourage you to keep your house when you move.
Sure.
So like, hey, you bought that house, you bought it for 5% down, keep it.
Yeah.
And then buy your new one with 5% down.
Oh, sure. Okay.
And now owning one property, your ROI on a 5% down payment and keeping that house and the cash flow that you'll have on that property it'll be better than
it'll work out.
It'll work out. It'll be good. The thing is again, we can argue against that, which is, okay, if you bought a property at 5% down and you let it appreciate, for example, let's say now you have $200,000 worth of equity in it. If you keep that property, and let's say it generates you $500 a month worth of cash flow, and it grows 4.8%, 85% over a year. The opportunity cost is the $200,000 that you could have sold the house and invested it in the stock market and made
more.
40 million in 47 years, right? My point is always like, hey, once that property becomes, you have 200,000 in equity or you have 300,000, you need to pull that money and do something with it.
Yep.
And even if that's pull that money and put it in the stock market, fine.
That still wins.
Fine.
We still win with that.
That's right. But don't give up. Don't lose the opportunity cost of all this equity that you're sitting on. So if you're trying to build tremendous amounts of wealth, I just showed a plan to get you to a net worth in 47 years of $80 million fairly easily, conservatively, if you stay the course. Again, if we talk about if you're willing to do even more work, so we already talked about how much work this involves, which is a business in itself. The next step is the BRRRR method or the house hacking method, where you're minimizing the amount of cash that you put into the properties. So if you're willing to move every 2 years, for example, then instead of doing every 5 years, you can do every 2 years. And then you can reborrow every 3 years on top of the 2 years against each one. And now all of a sudden we're talking hundreds of properties. And now what happens is, now we grow that net worth into like the 9-figure range, but the amount of effort, work, stress that's involved with that. So if you're just like one of these people that like your mindset is, I want to be worth $100 million and like, I'm willing to do whatever it takes to do that. Real estate is the way to go.
This is, I mean, as a financial planner, I can't do it because I don't have access to those dollars.
Right.
It's not possible. You have to have the dollars to invest over a long period of time to get to that number.
Right.
We can't leverage. As we talked about in the beginning, there's no leverage there.
Right.
Okay, so we can buy stuff on margin. It's not the same though.
Right.
It doesn't work apples to apples with that real estate. So to get to a bigger, higher net worth place, this is where you get another chalk, because I can't do that. It's not possible for me to do that. So as a financial planner working with individuals, you need to create a business. Most massive wealth comes from businesses,
and it could be owning a real estate,
which you just mentioned. Real estate's the business, so then it has to be. You has to be that. And I think the thing is, most people, and I think it was in our last episode we just talked about, is they're just not educated on finances, right? So the information you have about what to do and how to do it is self-learned, read, maybe some trial and error, or maybe some parents stuff. But in general, what we all know as a foundation is debt is bad, right? Like that's what we all kind of have ingrained of us. Debt is bad. Okay. Well, if debt is bad, leverage on a house is bad. Right. So it's hard for most people to understand that I'm going to take my $100,000, buy $500,000 of property. And then, it's going to get paid down a little bit in 5 years, but then I'm going to take another $100,000 out of it.
It's scary.
And then I'm going to take another $100,000 out of it. I never have that thing theoretically paid off. Right?
Never. Yeah. The point is, if you
always have it,
you will always have leverage.
Always have debt.
Yeah. So in this case, if you did the 45 property plan that we talked about, you have $16 million
of
in debt.
Yeah. Yeah. So for people, I think that's the piece that is probably the biggest hump you have to overcome in making this decision to do a real estate business.
Right.
Real estate investing has to be a business. I think that's kind of something we've come to conclusion here is
100%
that we're not, real estate is an investment, but the investment is the business, and the business of real estate.
And it's certainly not passive.
It is not passive.
So when we're talking about the benefits of passive versus active investing, real estate is not one of those passive options. You can do it in a REIT, but that's a stock.
It's still a stock, and it doesn't really count, because here's you probably know some stuff about REITs. Unless, like, most REITs, you're buying companies that own properties. I mean, you don't actually own the damn property. Okay, so I buy this REIT over here. It's a housing REIT. No, it's actually companies that do stuff in housing.
Right.
You just don't even own the damn property.
There's so many REITs out there, and as long as they're involved in real estate, as a majority they can be classified in that that REIT. So it could be property management, it could be commercial building, it could be residential.
Yep.
And so you just have to research what REIT
it actually is.
Yeah, what you're putting your money into. But so it's really interesting because like it's funny as I've never actually had this conversation probably at this level to where I'm actually, there's some things I'm like contradictory on myself. Like there was a long time where I thought about it and I was like, I would never invest in real estate, or I would never invest in the stock market versus the real estate. Because I never saw a reason why, where, or a way that the stock market outperformed real estate, which at a high level, it will not.
High level.
At a very high level, if you're willing to create a business out of your real estate, the leverage is so powerful, you will not outperform it in the stock market. In fact, these returns that I just showed, like if you're willing to like these true annualized returns, because they're leveraged, ends up being right around 20%, right? And that doesn't count your cash flow.
Doesn't count cash flow.
And it doesn't count your principal pay down. And that alone, that 20% return would outpace Berkshire Hathaway, which historically speaking is probably the greatest stock of all time. Right. So but again, if you just do one and stop, it doesn't work. You have to be willing to take the risk that you feel when you're buying that first property, which I can tell you is there's stress involved in that. There's stress involved in the fact that you're buying a piece of property that you're not going to live in. And if someone else doesn't rent it for you, you have to make that mortgage payment also.
Yes.
There's a high level of stress there. And you have to do that over and over and over and over again in order for this thing to make sense. And so I've never really thought about it like that before. I've always just thought about it as like absolutely real estate, 100%. That's what you should do all the time. And it's black and white, and the numbers will always beat the stock market. And they do beat the stock market, but you have to do it. You have to be consistent with it.
It's gotta be consistent.
And you have to use the leverage to your advantage. If you don't use the leverage, then you might as well be in the stock market. And so it's interesting because now I'm like self-reflecting on this, and I'm like, okay, well, maybe it doesn't make sense sometimes. Right.
And that's the key here. Sometimes it doesn't, sometimes it does. And I think from where we're both studying at, I know when I've talked to clients and I give them the reality of it and I get them through the situation that they still want to, go for it. I'm going to be your biggest supporter because it's part of our plan that we're going to get you to someplace in the future, right? On the other side, though, is if I get them through the place, like, start questioning, that's why I told you. And I think from your side too, now like it's the same thing. Like if you're talking to clients and they're like, please don't do this. Like you're probably going to be miserable in the long run, but if you get them through it, let's do it. Again, either way, we're going to get you in a better place as long as you understand what you're trying to accomplish, and we understand it too. That's what we're here for. The other thing, you were talking about some of the stuff with owning multiple properties and the emotion with it. I've actually seen clients go through this where, that first property, one, you're buying it. Two, you have to have leverage on it. You have the mortgage. You have all this stuff that we mentioned, right? You care about those tenants. You know them. You feel that's the emotional attachment too. 2, you still care. 3, you still care. 4, you probably still care, but you care less because you've been beat up now a couple times. 5 and 6, and it comes back to my number. 5 to 10 is kind of that sweet spot of like starting to be a investment.
It make it worth it,
right? Because what you do, you get cynical at 5 to 6. You stop being emotionally invested also. If somebody puts a hole through that wall, great. Somebody will be over here in 30 minutes to fix it. Right?
The first property,
you're over there and you're frustrated.
And you're trying to evict.
Right. Like, this is literally the emotional roller coaster that you're doing with this individual, or that they don't pay you rent and they come to you with a sob story. Well, my car, it broke down, this, okay, well, we're not going to charge you rent this month, right? Number 6, sounds like, that sucks, man. Rent's due on the 1st.
That's right. Be
in my mailbox.
That's kind of funny to think about because you're right. There's a transition that happens like 1 through 5. There's a really high level of empathy, right? And well, I'm not going to raise rent because, they've been there for a long time and they're really great tenants.
They've been great.
And they change their own light bulbs. I'm like, they should be changing your own light bulbs. Like, and then you get from like 6 to 8, 6 to 10 or whatever. And now it's almost the opposite.
Yeah.
Right. You become cynical, like you said, and it's almost like, nope, sorry, take care of it yourself. And then it's interesting. It almost converts back once you get over 10, because now you realize it's a business.
Yes.
6 to 10 is not quite a business
not yet.
10 or more becomes a business, and you realize you have to operate it like a business. So 2 things happen. You have this combination of empathy, okay, but a business mindset, which is like, okay, hey, I get it. I understand that a rent increase is difficult for you. And you have to understand that my expenses, taxes are up, HOA is up, that kind of stuff. Can we meet halfway?
Yep.
Because when you're 1 to 5, you just don't raise rent.
Don't do it now.
When you're 6 to 10, you go, I don't care. That's what it is.
Right.
Like,
it's so true.
When you're 10 or more, you realize the cost of a vacancy is actually more expensive than taking a $50 hit.
Right.
And so you're like, you know what? Meet me halfway. I won't raise it 100.
Always
meet
raise 50.
They are super happy about it.
And you're happy about it.
And you don't have to find a new tenant because now you're treating it like a business. And so you're 100% right. Like, I never really thought about that transition that happens through there. But I mean, I experienced that. I was like, oh yeah, you have an emotional attachment to the house.
Yep.
Because it's your first one. And like you go over and the floors are dirty.
Right.
And you're like, I'm going to need you to mop out now.
I got to watch you do this.
And now I walk in and like carpets are destroyed and the walls need, and I'm like, yeah.
I'll have to fix that when you guys leave, I guess.
That's what I expect. It's a rental, and you get used. So you can't have that emotional attachment. So that's really true. So I think like it's really interesting now, because I never thought about this before, but like if I were to summarize this now that we've like talked through this for 30, 40 minutes or whatever, like if I were to summarize this, I would have never done this before. I would have been like, real estate always. But now you're right. Like real estate, if you want to get to this super high level net worth and just overall valuation, and there's value behind that, by the way, because you could liquidate all these assets at the end of your life, or when you're 60, whatever. You can start this when you're 20 years old, be 67 years old, liquidate everything and have $80 million in the bank. And I don't even want to get into tax advantages, and
that's a deep hole.
Totally different. We have an episode on taxes and stuff like that. But because that would, at first I was like, that's my other argument. I have a huge tax advantage over stocks. But if you put that 100K in a Roth, you just eliminate my advantage right away. Yep. And so now I'm like, all right, so that doesn't work, because the Roth is easy. It's an immediate like elimination of taxes. In order to eliminate or defer or whatever your taxes on all this real estate at the exit strategy, there's a lot of stuff that has to be done. Yeah, it's a ton of work.
Right. So I mean, if we're just doing straight, even if we throw taxes in with the S&P 500, you're going to pay taxes every year on gains that are distributed from the dividends.
Right.
So you have an increasing cost basis every year.
Yep.
Which is a good thing. At the end, if you sell it off, you now have some cost basis there.
Even in a Roth?
Not a Roth. No.
Just
general investing, and that's what you're probably going to be doing with real estate too. Like, it's going to be in a non-qualified status, right? So I hear arguments all the time about real estate's so tax efficient. Well, it is on an ongoing basis, but if you don't do it properly at the end, it's actually very tax inefficient. Correct? Right? Yeah. Because if we depreciate every year, which we should be offsetting our income, that's an awesome thing. But the problem when you sell it is you have no cost basis anymore.
Yep.
Right? Like now, again, this is from a very, very basic level.
Yeah.
There's ways
around it, but yeah.
There's ways to work with it, but if we're just looking at it strictly like black and white, we're just depreciating it, we're going to sell it in the end. Well, we have no cost basis, so it's actually costs a little bit more. So taxes is another one that it can really, really help or could really, really hurt depending on the structure that you do it in.
Yep, it has to be done right. There's no doubt about that.
Every time.
And so anyway, like I said, to kind of to summarize the whole thing, like if you want this really high net worth and want to build a tremendous amount of wealth and maybe want to build a legacy for your family, like real estate.
It's possible. Yeah.
Like real estate. But if you're just you don't want a business,
not gonna work.
Maybe the stock market's right. I would have never said. I can't believe I'm saying that right now.
It's fun. But think about it. As you think about the people who've done this, like big names, right? Rockefellers. You mentioned Trump earlier. Like him or not, he's built a massive real estate empire there. The people who have done it are less and few and far between, because it's not everybody, because it's not easy.
It's not easy.
But they literally followed your plan, let's call it.
Yep.
And they now are worth hundreds of millions of dollars because they did this.
Yep. And they were consistent with it. Very consistent. They took big risks.
They took massive risks. So you have to do that.
They were highly leveraged, at some point, where stocks you're not leveraged at all, really.
If you have a bad day and you lose your job, guess what? It's still going to be there.
Yep.
You don't have to pay somebody's mortgage.
And the liquidation of stocks way easier than,
You give me a call and it'll be done. Well, it's after hours now, but it'll be done tomorrow before 2, right? Like if you need to sell your house tomorrow,
we got a couple months maybe before we get it. I mean, actually money in your bank.
Right. This will be 30 days. At least the best case scenario. You get an offer on the table and we happen to be able to list it, take pictures of it right now.
Yeah.
And we have to go now, go take pictures. And then I have to be really good up all night, writing the contract, getting it on MLS, getting the pictures cleaned up, get it out there. We have somebody walking because we priced it right. They put an offer in, they gave it to us, and we close in 30 days, right?
Yeah. So if you're willing to work for it, if you're willing to put work in, if you're willing to have a business out of it, the real estate side works and it works really well. But if you're just you want this set it and forget it mode,
it's not going to be real estate.
It's not going to be real estate. It's really not. And that's it's fun to kind of put that into perspective for me now, because I was like real estate, but that's because my mentality is it's not a big deal to be a landlord. It's not a big deal to run this side business, but for some people it is.
It's a lot,
and it can be a lot.
It's
and
scary.
So it's really interesting, because I always was like, man, everybody should be doing it. And if you're willing to follow this model, yes, everybody should be doing it. But the amount of people that are willing to follow this model without straying and without dropping it. And the nice thing is you could pivot. If you did 3 properties and you were like, this isn't for me, you could pivot and you'd probably do fine.
Yeah, all right. In general. Yeah. I mean, there's been a few times in history, if you just happen to buy 2006 and 7 and okay.
And try to sell in 3 years.
That was a bad idea. But this is where I went back to not making a bad decision. All right, this sucks. It's going to suck. You have to let it suck.
That's right. Don't sell.
Embrace this suck for a couple more years, because it will get better.
Right.
The problem is it's not today.
Right. Which is the number one thing that I tell people anyway. If you're not willing, you don't have to, but if you're not willing to hold a property for 10 years, don't do it.
Don't do it.
If in 3 years you can sell it and make a killing, do it. Go ahead.
Have at it.
But you have to be able to weather the storm.
Yep, got to give it that time to get through it. So,
well, cool.
Interesting.
Well, that was a fun conversation. This is probably one of my favorite ones, because I feel like I came to some self-realization through this.
I saw it happen too.
It just happened. I'm hang on a second. I've been telling everybody, but the reality is you have to, and that's why both of us have talked about before. We sit down and talk. What are you trying to accomplish?
Yep.
Because if you're just I just want to buy one rental property. Okay, why?
Yep.
Because you grew up wanting to be a landlord.
Yeah, it's because
it is sexy, right?
It's sexy. It really is.
Yeah.
It's the next thing you just do when you've kind of finally made it, right? I read the books that everything the media says. Once you made it and you have discretionary cash flow, you buy another property.
Buy property. Yeah. Well, in that case, go buy a vacation home. Then that's cool. Go buy something you can enjoy.
But you have to be able to do it and go enjoy it. But don't make it an investment. That's I say, oh my gosh, so many people do that all the time. I'm gonna make this work. You can't make anything work when it comes to an investment. You try to force an investment to do something, you will always lose.
It's not gonna do it. Yeah.
So just again, this going back to your point. What's your point? What's your goal? What do you want to accomplish with it? As long as you're on the right page with that, you're going to be just fine. Use quality professionals in this situation.
Right.
It really helps out having the conversation of unbiased opinion, who's truly looking out to make you in a better place, irrelevant of where you go. That's what I've come to the conclusion every single time. I'm I have no skin in the game here. I just care. That's all it is.
Yeah. Well, that's man. See, now we gotta have Clayton back, because this is a great conversation, right? This is the first one where I came to some I need to go home and like pray on this.
Yeah, some Dalai Lama stuff going on.
Yeah. Like I have some, like, I need to call and I have to like make some apologies.
Make some phone calls to some people.
You shouldn't have done that.
You know what?
Yeah, you should have done that.
Maybe you've been thinking about this a little bit different here.
I mean, yeah, I think, like I said, overall, the cool thing is though, and I tell this to a lot of people, is like, you can't go wrong. If you're one of the people that has done well enough to save money enough to make a nice investment,
correct,
you're going to be all right.
You'll be okay.
Yeah,
absolutely.
So
that's exactly in either situation. I don't care which one you're talking about at that point in time. Whether you put it in the market, whether you buy a property, you will not go wrong with either of those decisions at the end of the day.
Yeah,
and that's the best part about investing, right? Like, as long as it's a quality investment. Again, quality is the key.
Yeah,
going and buying the next hottest thing because you heard it on Jim Cramer.
Yeah,
probably not the right quality that we're talking about here. So that goes chasing things.
Right. That goes back to a couple of weeks ago episode of cost basis averaging. Like, when you have money, invest it.
Yeah,
cost basis averaging. That is how you
massive way.
That's how you get rich. Is just invest every Tuesday.
Be consistent
and exactly $100 every Tuesday. Buy the same stock or whatever. Sometimes you buy high, sometimes you buy low.
Oh my gosh, dollar cost averaging is one of the, we talk about compound interest being, I call it one of the wonders of the world. Sure. Dollar cost averaging is right behind it because it goes right along with it.
Yep.
Like they're brother and sister.
Yep.
So,
yeah.
Awesome.
Well, cool. Well, thanks, dude. Thanks for the conversation.
Yeah,
it was great.
It was
really
fun.
Good. So, Clayton's got a lot more to offer too. I think we have some other topics that we might be willing to hop on and chat about. So, I think we'll have some future episodes with him. But again, thanks for coming in and talking about some stuff today. And if you have any questions or anything that you want to talk with a financial planner about, call Clayton's team. He's got great resources and just a lot of education, and always willing to share that type of stuff, which is fantastic.
Appreciate it.
And then obviously my team for real estate, check out our websites. Go to Black Yeti Group, www.blackyeti.com. Check out our free resource guide on managing your own properties and decide if it's for you.
Yeah.
Outside of that, hope everybody has a wonderful rest of your day. Do something good with your money, whatever it is. Do something good with your money, and so that you can eventually retire. And do the things that you want to do and go live big like we try to do every day. So
awesome, man.
All right. Thanks, everybody.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyeti.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode. And until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.